Look, I need to show you something that's happening right now in the silver market that most people are completely missing. And I'm not talking about some theoretical scenario that might play out over the next decade. I'm talking about a convergence of forces that's creating what could be the most significant opportunity in silver we've seen in over 40 years. Let me start with something that should terrify anyone holding cash right now. The global silver market trades about $32 billion worth of metal annually. That's the entire physical market. Now compare that to what happened in just 1 week last month when institutional investors moved $47 billion into precious metals ETFs. Think about that for a second. More money moved into precious metals in 7 days than the entire annual physical silver market represents. But here's where it gets really interesting. While everyone's watching gold hit new all-time highs, silver is sitting at prices we saw 3 years ago. The gold-to-silver ratio just hit 89 to 1. Historically, that ratio averages around 60 to 1. In 2011, during the last major precious metals bull run, it dropped to 32 to 1. What that means is silver is currently the most undervalued it's been relative to gold in modern history. Now, I want you to understand why this matters beyond just some ratio on a chart. Let me tell you about what happened in March of 2020. You remember the chaos, right? Markets were collapsing. People were panicking. During that month, something extraordinary happened in the silver market that barely anyone noticed. The premium on physical silver coins shot up to $8 over spot price. You had silver trading at $12 an ounce on paper, but if you actually wanted to buy a physical coin, you were paying $20. Some dealers completely ran out of inventory. The U.S. Mint suspended Silver Eagle production because they couldn't keep up with demand. That was a preview, a stress test of what happens when physical demand overwhelms a market that's been operating on paper promises for decades. And here's the thing. That panic buying in 2020 was driven by maybe 2% of the population suddenly wanting physical silver. What happens when that number hits 5% or 10%? Let me paint you a picture of what's actually happening in the physical silver market right now. Global silver mine production is about 830 million ounces per year. That number has been essentially flat for the last 8 years. Meanwhile, industrial demand has exploded. Solar panel production alone is consuming over 200 million ounces annually now, up from 50 million ounces. Just a decade ago, electric vehicles use about twice as much silver as traditional cars. Every EV requires roughly 25 to 50 grams of silver just for the electrical systems. But here's what nobody's talking about. The Chinese government just announced plans to install 1,200 gigawatts of solar capacity by 2030. Each gigawatt requires approximately 75 tons of silver. Do the math on that. We're talking about 90,000 tons of silver, or roughly 2.9 billion ounces, just for China's solar ambitions over the next 5 years. That's more than 3 years of total global mine production. And it's not just solar. The defense industry is consuming silver at unprecedented rates. Modern missile systems, radar equipment, electronic warfare systems, they're all silver intensive. With global military spending hitting record levels, that's another demand source that's not going away. Now, while industrial demand is soaring, something else is happening that's even more significant. Central banks around the world are quietly accumulating precious metals at a pace we haven't seen since the 1970s. In 2023, central banks bought over 1,000 tons of gold. That's the highest level of official sector buying in 55 years. But here's what's fascinating. Several central banks are now starting to add silver to their reserves for the first time in decades. Why? Because they see what's coming. They understand that the current monetary system is built on a foundation of debt that can never be repaid. The United States alone has $36 trillion in national debt. The interest payments on that debt now exceed the entire defense budget. Think about that. We're spending more money just servicing our debt than we spend on our entire military. And the only way out of this debt trap is inflation. Not the 3% inflation they tell you about on the news. I'm talking about the kind of inflation that destroys purchasing power, that turns retirement savings into pocket change, that makes the price of everything you need to survive double or triple within a few years. You want to know how I know this is coming? Look at what happened in the 1970s. In 1971, Nixon closed the gold window, ending the dollar's convertibility to gold. What followed was a decade of monetary chaos. Gold went from $35 an ounce to $850. That's a 2,300% increase. But silver went from $1.50 to $50. That's a 3,200% increase. Silver outperformed gold by nearly 40% during that crisis. Why did silver outperform? Because silver has this unique dual nature. It's both a monetary metal and an industrial metal. When monetary crisis hits, people flee to precious metals. But unlike gold, silver also benefits from industrial demand that doesn't stop during a crisis. In fact, industrial demand often accelerates as governments spend massively on infrastructure and technology to try to stimulate their way out of trouble. Let me tell you about a guy named Jerome Powell. He's the chairman of the Federal Reserve, the most powerful financial position in the world. In 2018, Powell tried to raise interest rates and reduce the Fed's balance sheet. You know what happened? The stock market dropped 20% in 3 months. Corporate debt markets started seizing up. Powell immediately reversed course, cut rates, and started expanding the balance sheet again. That was with interest rates at 2.5%. Today we have rates at 5.5%, and the Fed is trapped. They can't keep rates high without crashing the economy and triggering a debt crisis, but they can't cut rates too quickly without reigniting inflation. They're stuck between two impossible choices. And when central banks are trapped, that's when precious metals shine. Now here's something most people don't understand about the silver market. The COMEX, the major exchange where silver futures trade, has about 300 million ounces of registered silver available for delivery. That sounds like a lot until you realize that the open interest in silver futures represents claims on over 900 million ounces. That's a ratio of 3 to 1. For every ounce of physical silver available, there are 3 paper claims on it. What happens if even a small percentage of those paper contract holders decide they want physical delivery? The system breaks. We saw a glimpse of this in 2021 during the Reddit silver squeeze. A group of retail investors on Wall Street bets decided to buy physical silver and take delivery of COMEX contracts. Within days, premiums spiked, dealers ran out of inventory, and the COMEX had to change their delivery rules to prevent a default. That was a small, disorganized group of retail investors. Imagine what happens when institutional money decides to move into physical silver. When pension funds, sovereign wealth funds, and family offices start allocating even 1% of their portfolios to physical precious metals. Speaking of institutional money, let me tell you what's happening right now that should make every silver owner pay attention. BlackRock, the world's largest asset manager with over $10 trillion under management, just launched a silver ETF that allows for physical redemption. This is huge. It means institutional investors can now gain exposure to silver through a regulated vehicle and actually take delivery of physical metal if they want. Why does this matter? Because it creates a direct pipeline from the massive pools of institutional capital into the physical silver market. Before, institutions were mostly limited to paper silver through futures or ETFs that didn't allow physical redemption. Now they can buy silver through a familiar structure and convert it to physical metal. That's a game changer. And it's not just BlackRock. I'm seeing a pattern across the financial industry. Major banks that spent the last decade telling clients to avoid precious metals are now quietly launching precious metals. Trading desks and storage facilities. JP Morgan has accumulated one of the largest physical silver hoards in history. Over 200 million ounces sitting in their COMEX warehouse. They're not doing that because they think silver is going down. Let me shift gears for a second and talk about something that affects everyone watching this, especially if you're thinking about retirement. You've probably got money sitting in a 401k or IRA, watching it get slowly eroded by inflation while the stock market bounces around like a pinball machine. Most people don't realize you can actually hold physical precious metals inside a retirement account without triggering taxes or penalties. I put together a free guide that walks through exactly how gold and silver IRAs work, what the rules are, how to set one up, and what to watch out for. If you've got $100,000 or more in retirement savings, this is worth looking at. The guide's in the description below. It's not some sales pitch. It's just information that I wish someone had explained to me years ago when I was trying to figure this stuff out. All right, back to what's happening in the silver market right now. I want to talk about supply because this is where things get really interesting. Silver is unique among commodities because about 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Only about 30% comes from primary silver mines. Why does this matter? Because when the price of silver goes up, you can't just turn on more silver mines. The supply is largely dependent on the economics of copper and zinc mining, and right now, we're seeing a global shortage of copper mine development. The major copper deposits are getting depleted, grades are declining, and it takes 10 to 15 years to bring a new copper mine online. What that means is silver supply is essentially fixed for the next decade, regardless of what happens to silver prices. Even if silver goes to $50 or $100 an ounce, we can't significantly increase supply in the short term. It's a supply curve that's almost vertical. Meanwhile, demand is accelerating. Let me give you some specific numbers. In 2000, total silver demand was about 850 million ounces. By 2023, it had grown to 1.2 billion ounces. But here's the kicker. Mine supply only grew from 590 million ounces to 830 million ounces during that same period. The gap between supply and demand has been filled by above-ground inventories, recycling, and government stockpile sales. But those sources are running dry. Government stockpiles have been largely depleted. The U.S. government used to hold over 2 billion ounces of silver in strategic reserves. Today, that number is essentially zero. China, which was a major exporter of silver, is now a net importer. India, traditionally a source of recycled silver, is now buying more than they're selling. We're approaching a point where annual demand exceeds annual supply, and there's no buffer left to fill the gap. When that happens, prices have to rise to either stimulate more supply or destroy demand. But as I just explained, supply can't respond quickly, and industrial demand is inelastic. Companies need silver for their products regardless of price, so the adjustment has to come through price. Let me tell you a story about what happened in 2011. Silver started that year at around $30 an ounce. By April, it had shot up to $49. That's a 63% gain in 4 months. What drove that move? It was a combination of factors: monetary uncertainty after the 2008 financial crisis, QE2 money printing by the Federal Reserve, and a surge in investment demand. But here's what's different about today versus 2011. Back then, industrial demand for silver was about 450 million ounces. Today, it's over 600 million ounces and growing. Back then, the federal debt was $14 trillion. Today, it's $36 trillion. Back then, the Fed's balance sheet was $2.5 trillion. Today, even after their reduction efforts, it's still over $7 trillion. Every factor that drove silver higher in 2011 is not just present today, it's amplified. And we're starting from a lower price point. Silver today, adjusted for inflation, is cheaper than it was in 2011. Think about that. Despite all the money printing, despite all the debt accumulation, despite the surge in industrial demand, silver is cheaper in real terms than it was 14 years ago. That's not sustainable. Markets don't stay disconnected from fundamentals forever. Eventually, price has to reflect reality, and when that adjustment comes in silver, it tends to be violent and fast. I want to talk about something that most analysts are missing. There's a generational shift happening in how people view money and wealth. Millennials and Gen Z, who are now entering their peak earning and investing years, have a fundamentally different relationship with traditional financial institutions than previous generations. They watched their parents lose their homes in 2008. They've seen their purchasing power eroded by inflation. They don't trust the system, and they're turning to hard assets. Not just Bitcoin and crypto, but physical precious metals. There's a growing movement of young investors who are buying silver coins and bars, storing them outside the banking system, and viewing them as insurance against monetary instability. This is a demographic shift that's just beginning, and it represents a massive new source of demand. Let me give you some context on what's happening geopolitically, because this is crucial to understanding where silver prices are headed. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus about 40 other countries that are now joining or seeking to join, represent over 45% of global population and about 35% of global GDP. These countries are actively working to reduce their dependence on the US dollar. They're settling trade in their own currencies, they're accumulating gold and silver, they're building alternative payment systems that bypass SWIFT and the dollar-based financial system. This isn't some conspiracy theory, this is official policy that these governments are openly discussing and implementing. What happens to the dollar when half the world stops using it for trade? What happens to dollar-denominated assets when demand for dollars drops? The value of the dollar falls, and the price of real assets, things like precious metals, energy, and commodities, rises in dollar terms. We're watching the slow-motion collapse of the post-World War II monetary order. It's not going to happen overnight. It's going to be a process that plays out over years, but the direction is clear, and the implications for anyone holding dollar-denominated paper assets are severe. Now, I want to address something that skeptics always bring up. They say, if silver is such a great investment, why isn't everyone buying it? That's actually the wrong question. The right question is, why isn't everyone buying it yet? The answer is that most people are still operating under the assumptions of the old system. They believe that central banks have everything under control. They believe that their dollars will maintain purchasing power. They believe that the stock market will keep going up forever. These beliefs are comforting, but they're not based on reality. The people who are buying silver now, the central banks, the institutional investors, the family offices, they're not buying because they think silver is going to make them rich. They're buying because they understand that the current system is unsustainable and they want to protect their wealth from what's coming. Let me tell you about the silver market in 1979. Silver started the year at $6 an ounce. By January of 1980, it had reached $50. That's a 733% increase in 1 year. What drove that move? The Hunt brothers, two billionaire investors, tried to corner the silver market. They bought massive amounts of physical silver and futures contracts, driving the price to unprecedented levels. Now, I'm not suggesting that's going to happen again. The market is different today, regulations are different, and there's no single entity trying to corner the market. But what that episode demonstrated is how explosive silver can be when physical demand overwhelms available supply. The market is thin, inventories are limited, and when buying pressure hits, prices can move faster than almost any other asset. Here's what keeps me up at night. We're in a situation where the fundamentals for silver have never been better. Supply is constrained, demand is accelerating, monetary conditions are deteriorating, and yet the price is still suppressed. It's like a spring that's been compressed for years. The longer it stays compressed, the more violent the release is going to be when it finally happens. And I think we're very close to that release. I'm seeing signs everywhere. Physical premiums are rising. Delivery times are extending. Dealers are reporting strong demand. ETF inflows are accelerating. The smart money is positioning. You know what the biggest risk is right now? It's not that silver goes down, it's that you wait too long and miss the move. Because when silver starts moving, it moves fast. In 2011, silver went from $26 to $49 in less than 3 months. If you weren't already positioned, you missed most of the move trying to chase it. I'm not saying you should bet the farm on silver. I'm not saying you should sell everything and go all in. What I'm saying is that if you don't have at least some exposure to physical silver right now, you're taking a massive risk with your wealth. You're betting that the current system continues to function, that inflation stays under control, that central banks can manage this debt crisis, that the dollar maintains its reserve status. Maybe you're right. Maybe everything works out fine. But what if you're wrong? What if the next few years look more like the 1970s than the 2010s? What if we get a currency crisis, or a debt crisis, or a banking crisis? What's your plan B? Physical silver is plan B. It's insurance. It's a hedge against the system failing. And right now, that insurance is cheaper than it's been in years, while the risks to the system are higher than they've been in decades. Let me leave you with this. In 1971, when Nixon closed the gold window, an ounce of silver could buy about 5 gallons of gas. Today, an ounce of silver can still buy about 5 gallons of gas. Meanwhile, the dollar has lost over 85% of its purchasing power. That's the power of real money versus fiat currency. Silver has maintained its purchasing power for thousands of years. It survived the collapse of empires, the fall of currencies, wars, depressions, and every financial crisis in human history. The dollar is 50 years old as a pure fiat currency. Which one are you betting on for the next 50 years? The window is closing. The smart money is already positioned. Central banks are accumulating. Institutions are building positions. The supply-demand fundamentals are the tightest they've been in decades. And most people are still sitting on the sidelines, waiting for confirmation, waiting for the mainstream media to tell them it's safe to buy. By the time that confirmation comes, by the time silver is on the front page of every financial publication, the easy money will already be made. The move from $25 to $50 is where the real gains are. The move from 50 to 100 is just catching up. This is your final chance to position yourself before the market wakes up to what's happening. Don't let this opportunity pass you by. The next few years are going to be unlike anything we've seen in our lifetimes, and the decisions you make right now are going to determine whether you preserve your wealth or watch it evaporate along with everyone else who trusted the system.